The latest salvation to that first-time buyer problem in the UK is here.
Okay, and what do you want me to do about that?
And it's lovingly called 95 mortgages or 95% mortgages here in the UK. Spoiler alert, guys, they come with quite a few problems, but we'll get into that. Don't worry, I'll be sprinkling those facts. So the 95% mortgage scheme is designed to capitalize on a few things.
I know it's tough now, but things will get better.
First of all, low interest rates. Second of all, low deposits at 5% caps, and also state guaranteed mortgages to help lenders lend to first-time buyers.
Goes a little something like this.
Speaking to first-time buyers here in the UK and in London specifically, which includes both colleagues at work and first-time parents that I chat to when taking the humans that I own to the pool now that it's open, the general consensus is people want to have a more permanent home or even larger space for the little ones who can terrorize and destroy tight spaces. But it has become apparent the scheme has quite a few drawbacks. So let's get into why the 95% mortgages may not be the salvation that first-time buyers are looking for.
Yeah, I don't think that's what it is.
So the government has a plan to use the 95% mortgages to turn generation rent into generation buy. Through a government-backed scheme, home buyers can put down a 5% deposit down payment on a house. The state-backed scheme helps first-time buyers, but also existing home buyers who are moving out and are eligible up to a purchase value of 600k. Now that's quite nice, isn't it? Buyer eligible, the scheme is not available to second home and buy-to-let property transactions, obviously, so that would exclude me. But the help is happening behind the scenes, where the government will step in and underwrite 80% of that loan if the buyer defaults. So the government is acting like an insurance policy, so the banks can feel encouraged to lend with loan to values of 95%. So it's good to see a targeted policy.
I had a very hard time believing this was true.
I myself will not qualify for the government scheme. It will still benefit liquidity to property investors in the short to medium term though. The reason I say that is that banks have a remarkable way of adapting and managing risk, and if the government is able to underwrite part of the risk by supporting first-time buyers, then the bank can increase risk by offering better options to property investors like myself. Well, that's a theory anyway, guys. Hurrah! But we'll see. Let's not get excited. Now, if we put the 95% loan to value mortgages into perspective, pre-pandemic data from Moneyfacts shows that there were 391 products available in March 2020, pre-pandemic and lockdown. But 1 year on, in March 2021, the number of mortgages available for 95% loan to value was just 5. Gosh, can you imagine? The air is starting to come back into the market, with products being available increasing thanks to the government scheme. Yay, well done you if you're a first-time buyer or family looking to upsize. The number one issue though, and which the new 95% mortgage guarantee scheme doesn't address, is improving affordability. The buying limit still exists, so you're able to borrow about 4.5 times your income, and that remains in most cases. So then those that benefit are those who already have high enough earnings to afford property in their area, but have been struggling to get together a big enough deposit. It doesn't help those in areas where property prices are just simply out of reach.
And that pisses me off.
Which of course we mustn't forget is a result for those that fit into this category, but probably not the solution the majority have been looking for. There's also a second drawback. With higher loan to value mortgages at figures such as 95%, there is a massive increase in the risk of negative equity. Now, I have a good friend who lives on the coast in the UK, and their property fell well below the mortgaged amount during the credit crunch, and that was scary times, and that made obtaining new mortgage deals post-crunch more difficult, but also made it difficult to move. 95% mortgages are more highly levered, and the most highly levered that the market can actually get away with. It doesn't take much of a dip in property prices to put a homeowner into negative equity. This is where the value of property falls below the outstanding mortgage balance. This should be a very serious consideration if we feel the UK property market is overheated and due for a property crash or correction. The main issue for a property owner where they fall into negative equity is the difficulty in moving and securing new fixed rate mortgages when the mortgage rate is up for renewal. And remember, you have 2-year or 3-year deals generally. Both are real challenges and quite distressing as well. There's also an additional observation which the consumer website which.co.uk found, and is quite alarming.
back rolls.
95% mortgages that are returning to the market are not attractive or competitive, that take advantage of the consumer and government. Now, these are strong words from Fifi, I know, guys.
Keep it up for me.
But now hear me out. Pre-pandemic, 95% mortgages for 5-year fixed were available for interest rates for less than 3%. A year later, and those interest rates have soared to 4%, which means the lenders are still not in competition mode and instead just sizing up the market. Contrast this to the 90% mortgages which remain buoyant with the number of products readily available. Rates are available at 3%, which is still about 1% higher than pre-pandemic. So right now, lenders are slapping on a 1% premium to lend post-pandemic. And that's a lot when you think about it. In short, mortgages for those with smaller 5% deposits is at an all-time low, with mortgage rates available to first-time buyers at a 3-year high. Another important statistic is even with higher rates and government security, 95% of applicants are still not getting an agreement in principle. That means they're not being approved. This is because of tough credit scoring and affordability criteria. The only way to avoid this is to get your paperwork in order. Bank statements clean, 2-year employment history down, and 3 months of pay slips. It's more important to be organized as ever. Despite this, wow, it has been a bonkers year for the UK property market, and being a property owner investor myself, I really wanted to understand how the crazy housing market will play out. And is there a bubble? If so, is it about to pop? Is there a housing crash? And of course, how will our Rishi Sunak handle it? So if you want to know too and help put this 95% mortgage scheme into context, then click right here for my video on why I don't think the property market is about to crash. Oh, turn that on mute.